Thank you so much, Cathie, for being here. We know you're busy, but this is a great time to have you on with so much happening in the markets and the global economy. I want to kick things off with a macro question. Um, you know, I know that you were really one of the first to say that we will be seeing rate cuts later this year. You were very outspoken about the Fed being too aggressive. We're seeing cracks in the economy. How do you see the weakness in regional banks playing out? And do you think it might continue to spread and have a major impact on the economy?
Well, I think that the liquidity crisis, they are beginning to get under control. I'm not going to tell you it's under control. I look closely at credit default swaps. They are improving for the regional banks. I also look closely at the KRE, the regional bank index, and those are improving, but more in a bottoming out way. There's no V shape here, and I think the reason for that is we're moving from the liquidity crisis to face the solvency crisis. The liquidity crisis is very abrupt, bank runs and so forth. That's what we went through. We think we've got that under control. When it comes to the solvency, these banks still have problems. The first problem is what everybody now understands, the interest rate mismatch. And from a liquidity point of view, they've plugged the hole. However, this is going to bleed out over earnings, and to the extent that any bank continues to lose deposits, and the entire banking system is in deposit outflow mode. So to the extent deposits continue to flow out, um, and banks need to tap the facility that the Fed and the FDIC have put together. What they will be tapping it at roughly 4.5%, maybe higher now that the Fed raised again 4.5%. Whereas the yield on their held to maturity securities it depends on the institution. Silicon Valley was 1.6, but I heard that, and I really don't want to use names because I don't want to cause a run on them, and I don't think we should. It's just going to be an earnings hit. Schwab had 1.7, I learned. So they'll be upside down, and their net interest margins will turn into net interest losses, which will feed into earnings. So that will be a slow bleed. I have been very focused, and thank you for mentioning it, Jennifer. I've been very focused on the fact that M2 is down on a year-over-year basis. It turned flat and then negative in January and February, and I don't see why it's going to turn around, especially with the Fed continuing to move interest rates up. So I do believe the Fed has made a very big mistake. Credit default swaps have been warning us about this since last January a year ago. And then the inverted yield curve started telegraphing the same thing in the in July period, and then commodity prices falling again. But the Fed is looking at lagging indicators, and it does not seem to be populated by people who have had experience in the markets. That has to be my only conclusion.
So we had Jeffrey Gundlach here, I believe 2 weeks ago, and he told me that recession's just around the corner. He said, I believe June or July. Anthony DeRosa backed me up on this. I believe he said in a couple of months. Is the Fed done?
They should be done. And I'll just go back to a very elementary economic equation. Anyone who's taken economics knows that MV equals PQ, and it's an identity. So PQ is nominal GDP. P is prices, Q is quantity. Nominal GDP, when you put them together. The other side of the equation is money. Money and this is on a year-over-year basis. Money is negative, 3% year over year. GDP is up 7.4% year over year. What has plugged that difference is velocity, the velocity of money. With this bank run, we are looking at the velocity of money flattening out and turning down now. So you've got money down, and we believe these are estimates, but we believe that a velocity uh, on a sequential basis has turned down. On a year-over-year basis, just because of base effects and so forth, it may not. That tells us that nominal GDP growth is going to slow down dramatically first, and we probably are going into a hard landing because the Fed just doesn't see this. It's and what the
So
Fed has
you're
done.
not in the this is you're bracing for a hard landing.
I'm bracing for a hard landing. Yes.
I'm going to bring in my enterprise editor, Erin Arvidlin here. Erin.
Hi, Cathie. Great to speak to you. I'm thrilled that you brought up M2. You seem to be the only person talking about this. Can you explain for the layperson, but also for the investor, where you see M2 going, why it's so important, and when you see it turning around?
Yeah, 85% of M2 are demand deposits, which are outflowing um, from the banking system and moving into treasuries. It's a flight to safety, treasury securities or higher yielding money market funds. What this crisis ironically has done, I mean, I did it. I didn't know that I was in some very low yielding deposits. And so I've moved to money market funds, treasuries, safety. And so what has happened is this has been an advertisement. What are you getting on your deposits? If so, so the irony here is now this is perception, but that's important. The irony is people who noticed that they weren't yielding very much in this that deposit bank are moving the money out into money market funds. They're getting a higher yield, and from a perception point of view, they are lowering their risk. And from a bank to bank point of view, they are lowering their risk. So, I don't think the Fed understands. Again, just looking at the resumes of people on the Fed, sure, some of them have economics degrees, they're very academic, or regulatory. They haven't worked in the markets, and I really believe they don't understand how serious these red lights are.
Let me ask you, just from a portfolio point of view, how has this changed how you're investing? I mean, you've been really like right on close with the Nasdaq. And tell me what's going on with your portfolio companies as a result of what's happening.
Well, we're doing much better than the Nasdaq this year, which is up double digit. Um, and I think the reason for that is because of what has happened in the last 2 years. Our portfolios, which are long duration portfolios, 5 year investment time horizon, our portfolios were hit not just last year, but starting in February of 21, when people were being vaccinated, going back to work, and just the fear of higher interest rates started to enter the market. As a long duration strategy, many people consider our strategy higher risk, and some metrics from some metrics point of view, like volatility. Uh, that is correct. We don't look at volatility as much as risk as we do uncertainty of over a 5 year investment time horizon. So we started underperforming February of 21 through December. And I did write an open letter to the Fed last October, at which point I just threw up my hands and said, okay, I've said my piece and it's out there. And let's just focus on innovation again.
And
I think what happened in the fourth quarter, normally we have a Santa Claus rally. We did not. What happened is the bond market bottomed out. Yes, bond yields topped out at 4.1 or 4.3% in October. Many people out there were screaming at the Fed to continue raising rates. Inflation was still out of control. They were treating this like a 70s style inflation, which it is not. That's the danger here. And I'm talking about Larry Summers and Mohamed El-Arian. Again, they have never, I don't believe they have actually managed portfolios. This is what it seems to me. Um, so the bond market, however, faked everyone out. And asset allocators had shifted away from bonds because all of these very important dignitaries were saying, this was going to go on for a very long time. And so I think the asset allocation shift toward the end of the year was not towards the Santa Claus rally and stocks that had been beaten up, but towards bonds, so that they weren't caught flat-footed. However, I do believe now the opposite of what started happening in February of 21 is happening now. People see the end of this interest rate move, and they are beginning to fear the risk of deflation. And one thing about technologically enabled innovation is it is inherently deflationary. Deflation in the good sense, though. As prices come down, units boom. That's why you're seeing electric vehicles boom. But most of the economy is pretty mature, and a deflationary environment would be very damaging.
Let me I'll do my last question, which is, you mentioned EVs. So what is your commitment to Elon Musk's vision for Tesla and electric vehicles in general?
Well, he's shown the way, and it's been one of our largest positions for the last 5 or more years. And as we examine the barriers to entry that Tesla has, they're only getting larger. The question we get all the time is, wait, now he's facing all this competition. Yes, but if you examine the competition and you look at the battery technology, you look at the AI chip. In fact, Tesla is the only company with an AI chip, its own designed AI chip, taking a leaf from Apple's book. And probably the most important barrier to entry of all is the body of real world driving data that its 3 million robots around the world, Tesla 3s, S's, and so forth, Ys, have been collecting. And those models are only getting better. Yesterday, there was a video from Scotland, and I hope it was real. I hope it wasn't a fake. That's what we always have to ask ourselves now in this new world of AI. But it showed Tesla, an autonomous vehicle, and a Scottish couple in the back saying, remarking as one does, wait a minute, there's no one driving. And so we think they're much further along on autonomous than anyone gives them credit for. And if you look at our price target, which is in print at $1,600 for 2026, we get roughly 1/3 of that is their electric vehicle business, and then 2/3 is autonomous. So from the $190 or wherever it is right now, we expect roughly $500 price target just from electric, and the rest of that 16 from autonomous. And very, very few analysts are including autonomous in their models.
Okay, thank you.
Cathie, again, just circling back to the hard landing prediction from you. What does that mean for crypto? Because I did see a few comments from you talking about how crypto is a flight to safety trade. Can you expand on that?
Yes, it's very interesting. And I will clarify, when I say hard landing, that is given the Fed's current stance. If the Fed, cut interest rates by 200 basis points, recognize the seriousness of the condition we're in, maybe they could. Well, certainly the market would look through a hard landing, which is beginning to get baked into the cake. So crypto, very interesting. On the Monday, the morning that the president gave his address, the market started out down, and Bitcoin, I think, got to $19,000. And then all of a sudden it turned around as regional banks were imploding and bank runs were in the headlines. Crypto moved, or Bitcoin moved from 19,000 to, I think it crossed 28,000 at one point. It's around 27,000 right now. That's an indication that Bitcoin is a flight to safety. And why would that be? Well, unlike our banking system, and unlike FTX and Celsius and 3AC, uh, the Bitcoin network is uh, decentralized. It's the most decentralized and therefore secure network out there. It is the most transparent network out there, and it is auditable. It's pseudonymous, but you can see everything going on out there. There's even a rumor out there that, and this is purely rumor, but one of the government agencies, which has been seizing crypto, I guess, from criminals, has been letting some out now to take advantage of this price move. And you can see these movements on chain. You don't know exactly if that's a government account. But it's so our confidence in Bitcoin in particular and Ether has gone up in here. Why? Throughout last year, when you had the implosions of these centralized opaque institutions like FTX, um, uh, Bitcoin and Bitcoin, the network, and Ethereum did not skip a beat. They did not miss one transaction. They did not, they satisfied all margin calls because they're over collateralized ecosystems. And so I keep pounding that drum, saying, "Look, Bitcoin and Ethereum haven't skipped a beat. Look what's happening to our banking system." So, and in fact, I did an in the know. We call the YouTube series "In the Know" it came out last Friday with Art Laffer of Laffer Curve fame, a mentor and friend of mine. And he said to me, it was a soul searching, honestly. It was a brainstorm between the two of us. Normally I'd have this in a phone call, but I figured, what the heck, let everybody hear this and hear sort of the thought process. And Art very interestingly said, you should include uh, cryptocurrencies, at least Bitcoin, in with money. And which is great. Money, M2 is 21 billion, and Bitcoin is 500 billion, 500, yeah, 22 trillion, I should say, 21, 22 trillion, and Bitcoin is 500 billion. So it doesn't make that much of a difference yet, but it could, and it could solve the velocity problem. So
Cathie O'Donnell, I'm going to bring you in. I know Cathie Wood, you have a couple of minutes with us. Cathie, why don't you just lunge in with your question?
Hi, Cathie. Thank you so much for joining us today. Speaking of Bitcoin, the SEC, as you're very, very aware, I'm sure, is yet to approve a spot Bitcoin ETF. And earlier this year, the SEC again rejected a spot Bitcoin ETF by ARK in 21 shares. Do you still have faith one day that the U.S. will see a spot Bitcoin ETF, an SEC-approved spot Bitcoin ETF? And if you do you have any kind of forecast on when that might be?
Sure. Well, the SEC, as Grayscale is showing in court, has been extremely inconsistent here. It has approved a Bitcoin futures ETF, which is subject to swaps risk, but it will not approve a Bitcoin spot ETF, which is not subject to that risk. So it's highly inconsistent. And I think the SEC will lose the Grayscale case. They just lost the Binance Voyager case, Binance is being allowed to buy out Voyager assets. And there is another case, yes, the Ripple case. It seems like they might be on the way to losing that as well. So, yes, we do think there's going to be a Bitcoin ETF. We don't, this court case. I think that the verdict, if that's what you call it at this stage, will come out in June, and then I would expect the choice to be put to the SEC. Either you shut down the Bitcoin futures ETF that you approved, or you approve a Bitcoin spot ETF.
And do you think, given that choice, what do you think is going to happen with the SEC? What would they do?
I be, That's a very good question. I'll have to see when that Bitcoin futures ETF was approved. I do believe it was on Gary Gensler's watch. So here's the answer: if it was approved on Gary Gensler's watch, then they'll approve a Bitcoin ETF. If it wasn't, if it came after, then they may not, because the SEC, the Gensler SEC can blame the last SEC for making a blunder. But it's the thing is, even when it comes to what is a security, Coinbase was approved in April of 21, and it had many of what the SEC now is calling securities on its platform, and yet was not asked to register with the SEC as the SEC was approving its IPO. And in that S1 to go IPO, it mentioned staking 57 times, including the risks. So, there's quite a bit of inconsistency at the SEC. A security, I've been saying recently, if it walks like a security and it talks like a security, then it's a security. Well, the definition of a security has not changed since the SEC approved Coinbase with the securities it had on its platform at the time.
And one other question, Cathie, if I could kind of, we cover obviously at Pensions and Investments pensions. And I was interested to see that the state of Wisconsin Investment Board held shares of three ARK ETFs as of December 31st, according to its 13F. Why do you think more pension funds don't make greater use of ETFs? And do you see that changing at all?
I do see that changing. It has been very interesting to watch the institutional use of our funds. Actually, it was Asian pensions and I guess sovereign wealth funds that started using our ETFs, much in the same way they've used the S&P and the NASDAQ to fulfill a need quickly, right? An allocation need quickly. And that you can do with ETFs. They're highly liquid. And with the ecosystem around ETFs, the authorized participants, the market makers, and the ways that they handle both creations and redemptions, it's, our spreads hardly skip a beat when we have a huge inflow or a huge outflow. And we don't have many huge outflows except for maybe in early 21. And in fact, we've been in our net retention has been shocking. So we don't have a lot of trading accounts. What we do have, though, are sovereign wealth funds, I do know, who are in because they can treat ARKK or ARKG for our genomics or multiomics strategy, or ARKQ for our autonomous technology and robotics strategy. They can treat them as stocks, and they have some latitude. The people who are running the fund, instead of raising the approval all the way to the top, to the CIO. So we've seen quite a bit of that, and I don't think Wisconsin still holds. At least I think I I think I saw a report saying they were out. Maybe they're still in. So they might have expected a Santa Claus rally that did not come and left, but unfortunately, they missed. If that happened, they've missed a big rally in here. So I've often said we are the new NASDAQ, not to take a dig at the Nasdaq, except to say it fulfills a role. It and the S&P 500 are beginning to look more and more alike, and I guess the MSCI, although I don't know that one that well. And we are what the Nasdaq used to be in the 80s and 90s. We are exposed to innovation, and so when you don't see fangs in our portfolio, it is because we see them being disrupted, whereas fangs are the largest parts of the Nasdaq and the S&P 500. So you won't find most of our stocks in those broad-based benchmarks, and so we're a very good diversifier, and we are access to pure play, truly disruptive innovation. And what we're seeing with Chat GPT right now and GPT-4, we see huge disruption to Google and Apple now that Chat GPT has included plugins. We see TikTok has come after in terms of time spent at Netflix and Facebook and all of the other social networks. We'll see what happens there. But there's a lot of disruption now. The fangs used to be the disruptors. Now there's a whole new layer of disruption heading directly for them.
Anthony DeRosa, why don't you close us out here? I know that Cathie has to go in a few minutes.
Hi,
And
Cathie. Thanks for joining. Go
I
ahead,
can,
Cathie.
given that we have the technology issues, if you'd like to go another 5 minutes, and if
Absolutely. Anthony, why don't you go ahead?
Thank you, Cathie. I know that Block is one of your largest investments, and I'm sure everyone's seen that there's this short seller that's making accusations about Block, that it facilitates criminal activity, and that fraud is running rampant on the platform. How do you respond to those allegations that are being made, and how do you generally feel that we can find a way to deal with the fact that it does make it easier for some nefarious activity to happen, not just on Block, but on crypto and blockchain in general? What would be your response to that?
Well, we've already responded. Max Friedrich, our a fintech analyst and co-lead of our venture effort, put out a long tweet or Twitter thread, and then I added on. And what he surfaced, exposed, is what I would say, is that if you look at exactly the point you're making, if you look at the source document that Hindenburg used to find the $85,000 that Cash App and other fintech companies provided to people, PPP payments that shouldn't have gotten them. And you look in points, I think A, B, C, and D, not just E, F, and the rest. You will see that Bank of America was the source of 1.2 million. This is a government report. $1.2 million in fraud, in that particular fraud. It was a wrapper, and that's just one person. So Bank of America, 1.2 million. He doesn't mention that, and Bank of America sent to Cash App. So it emanated from Bank of America, which is supposed to have all these controls in. And the reason we know that is when I was on the Block calls, earnings calls during COVID, they allow their customers to ask a few questions. Well, instead of asking questions during that time, they came on and expressed such gratitude, saying that they had called their banks trying to get access to PPP, but their banks either wouldn't pick up the phone, they were too busy, or they wouldn't be able to get them the money from anywhere from 10 days to 3 weeks. Cash App, because it has, and this is recognized within Silicon Valley, one of the best cybersecurity teams in the country, probably in the world. And it has to, because it's serving low end consumers who are bankless, and at least this was its start, and very small business merchants. It has to have an excellent cybersecurity program. So, if anything, if the government, which they finally did, started working through Square. At first, they weren't working through Square. They were going to have a much better outcome than from a fraud point of view. Hindenburg, I have no respect for.
Switching topics a bit, what would you say is the biggest misconception that people have about your thesis at ARK? What do people get wrong about what you're trying to achieve?
Well, um, it's a couple of things. I'll tell you how this has happened. Um, during the 80s and 90s, that was a time of real innovation and excitement about innovation. And then we had the tech and telecom bust, and even worse, the 0809 meltdown, and then COVID. Uh, and primarily because of those first two, we had the investment industry basically moving into risk averse mode and beginning to depend more on benchmarks, which they really didn't use that much before the tech and telecom bust. And so we have a world which has moved, really has gone passive and is somewhat backwards looking. And if you look backwards at the last 50 years, we have been in a linear growth world. Uh, and uh, and the only time investors have heard this concept of exponential growth was in the tech and telecom bubble, and that ended badly. And there's a lot of muscle memory around that. The reason it ended badly is because too much capital chased too few opportunities too soon. The opportunities, the dream was right, but we didn't get the cloud until 2006. We didn't get the first big breakthrough in AI, deep learning, until 2012. We didn't get the second big and monstrous breakthrough in AI, uh, transformer technology, until 2017. And the costs of all of these technologies back then were way too high. It cost I think it was $2.7 billion to sequence the first whole human genome in 2003. Now we're down to $200 in a few hours instead of 13 years of computing power. So if you look at our big ideas 2023 on ark-invest.com, you'll see what we think about the next 7 to 10 years. We think that truly disruptive innovation, which is priced in the global equity markets, both public and private, at roughly $13 trillion today, is going to scale to $200 trillion by 2030. That's a 40% compound annual rate of growth. Those are the technologies themselves, right? And why are they going to do that? They'll probably end up at 60 to 70% of the broad-based benchmarks. They will catch up eventually. And if you were just to use the securities in those benchmarks today and whatever else is left, we think that will be a very sub 7% return. That's been the long-term return of at least public equities over the last 100 years. We think it's going to be subpar in the traditional benchmarks as they catch up with some of these exponential, and we would submit super exponential growth opportunities. Please check out Big Ideas 2023 to see what I mean by that. We think that truly disruptive innovation will account for the majority of these indexes.
Jen, I'll kick it back to you because I know we're running low on time.
So, Cathie, what's at the top of your worry list?
The top of my worry list is that the Fed still does not have the plot. and is still wondering if it should raise interest rates again. So that's, half of the solution is understanding the problem. The way they've bifurcated this problem is to say, okay, we have tools for financial stability, and our mandate right now, our priority is to control inflation. I do believe we'll be with what has happened, that we will see deflation. Some of it will be bad deflation. Some of it will be good deflation, because technologically enabled innovation is deflationary, highly deflationary. And we can see from electric vehicles and some of these other technologies that they're now getting to a high enough base that they are going to start moving the needle in terms of inflation metrics. And you can take the example of electric vehicles. Electric vehicle costs, and Elon's going to make sure of this, electric vehicle costs are going to, now that we're away from the supply chain problems, they will start declining in line with the battery technology and drivetrain technology and the autonomous technology. We think at scale, the cost to take an autonomous vehicle will drop well below where Uber is. Ultimately, at scale, it will be more like 25 cents per mile instead of $2 per mile. So highly deflationary, but huge opportunities, huge opportunities.
Cathie, we're going to leave it at that. Thank you so much for your time. Hopefully we can talk soon.
Thank you, Jennifer. I apologize. It was my fault. I don't want you to take any of the hit for this. Computer, not on my phone. I was waiting for a picture to show up. I'm Thank you for understanding.
All right. Thank you, everyone.
All right. Take care.
All right.
Bye-bye.
Bye-bye.